Hey guys, welcome to the hashtag Get Real Woke podcast. I'm your host, Frederick D. Scott. I'm a private equity investor, a business consultant, philanthropist, author, and contributing writer for Entrepreneur Magazine. I have over 15 years of experience in the finance industry, and I used to own an investment banking and advisory firm. Currently, I hold the financial modeling and valuation analyst designation, capital markets and securities analyst designation, commercial banking and credit analyst designation, and a diploma in Islamic finance. And today is hashtag for the Free Friday. This is the time during the week where I come on and I teach you step by step in an easy to understand format everything that I think you need to know to be able to accomplish the things you want to accomplish in your personal and professional life. Now, before we continue our journey into retail investing, I need everybody to hit the like button, hit the subscribe button, hit the bell notification at the bottom of the video, leave me a comment at the bottom of this video to let me know what you think. And if you're on an Android phone, definitely hit the join button. If you're on an iPhone, definitely hit the link in the description or the link pinned to the comments so you can join the hashtag Real Woke live chat community and be eligible to participate in the hashtag Learn to Earn Cash giveaway, where I am giving away a minimum of $1,000 every single month right here live on the hashtag Get Real Woke podcast. In fact, tomorrow at 7 p.m. Eastern Standard Time, live right here on the hashtag Get Real Woke podcast, I am going to be giving away another $1,000. Another one. And so that in mind, make sure you join the hashtag Real Woke Live Chat community so you can participate. All right, let's get into this. So now we are continuing our journey into retail investing tips. And today I want to talk about insurance, right? Because what I've realized is there are three things in this life that are undefeated: karma, taxes, and death. They are undefeated, right? So with karma, the only way you can avoid that is by doing the right thing every day, all day, 24/7. Impossible, can't be done. So you're going to have, different varying degrees of karma throughout your lifetime. Taxes, well, you can lower your tax liabilities, but can you completely bring your business and your personal taxes all the way to zero? No, you're going to pay some taxes. That's just how that goes. And death, well, death is an inevitability of life for everyone. And so that being the case, last I checked, technology hasn't advanced enough to keep people living forever. So death is what it is. And so since death is inevitable, right, then the question is, should you be prepared for death, right? Should you have insurance in place? And what I find is most people are very uncomfortable thinking about death, preparing for death, talking about death, all of these things, right? But the fact of the matter is, since it's an inevitability, you might as well prepare for it, right? You might as well make sure that when it is your time to go, when it is your time to leave this earth, that your family isn't left having to set up a GoFundMe page, a car wash, or a bake sale to pay for your burial expenses. That just makes no sense when you can prepare for it in advance by simply having an insurance policy in place. So let's talk about insurance today. Now, first and foremost, let's get into what it even takes to be able to, for someone to even be able to sell you an insurance policy, right? So when I explain this to you, I want you to think about this when someone comes and talks to you about insurance, because if they ain't got these things, you probably should be talking to them. In fact, there's no probably to it. You should not be talking to them at all. So the first thing you need to be able to sell insurance is a life insurance license. And so life insurance licenses are issued by the different states in the United States, right? So depending on what state you're in, they have different kind of rules and regulations for how they govern life insurance sales and life insurance policies in that state. And so the first step is to get a life insurance policy. I'm sorry, not a life insurance policy, but a life insurance license. And so with a life insurance license, you are able to sell all life insurance products that do not have a cash benefit or are tied to a securities index like the S&P 500, et cetera, right? So that would cover like a term life insurance policy. So you can sell term life, right? Now, if you want to sell other types of insurance products, such as the variable universal life insurance policy, the variable life insurance policy, both of which we're going to talk about today, you have to have a Series 6 and a Series 63 license. And so the Series 6 is issued, you take the test with the Financial Industry Regulatory Authority, FINRA, and you take the Series 63 exam is governed by the FINRA as well, but that's a state license, right? So Series 63 is a state license. Series 6 is an SEC license, but the SEC does oversee both licenses, and you need to know that. So the first thing you need to understand is that when you are considering setting up life insurance and you're talking to someone that sells life insurance, you should probably check their licensing. So you should check their licensing with the state for the life insurance licensing, and you should be at sec.gov to check out the licensing that they have with the SEC, the Series 6 and the 63. Now, it is true that with the Series 7, you can sell variable products, right? But generally, people that specialize and only sell insurance and don't really do anything else in insurance-based products, they typically only get a Series 6 and 63. So you need to be aware of that. And you need to be checking in the database. You want to see if they have any disciplinary history, if they've been in trouble before, if their licenses are even current, if they've ever held a license at all, right? If they haven't a license currently, because it really doesn't matter if they had a license before and then they don't have a license now. What matters is today, right? If they had a license a year ago, a week ago, a day ago, if they are not licensed at the time that they talk to you, that is a violation of federal and state law. They cannot talk to you and try to sell you insurance products. Can they provide general educational information? Sure. Can they solicit you for business to sell you a policy? No, absolutely not. That cannot happen, right? So let's be clear on that. So I always, when I talk about these sorts of things, and you have to talk to somebody to be able to get these types of products, I always want to make sure that we're conducting the right level of due diligence up front with the person that we're talking to. So that being the case, we've checked their licensing. Now we want to check peer reviews. We want to Google their name. We want to see what other customers say. We want to ask them if they have customer references that you can talk to, et cetera, to verify that not only are they licensed, but that they are credible, that they put their customers first, that they take care of their customers, et cetera. Because there are a lot of licensed people that sell insurance that operate in what I would call unscrupulous means. And even though they're barely on the right side of the road, they're barely legal, right? At the end of the day, they do you more harm than good. And we're going to talk about that as we move forward. So let's get into the first life insurance product. So the first life insurance I want to talk about today, the first life insurance product is what's called a term life insurance product. So a term life insurance product is typically sold in term lengths of 1, 5, 10, 15, 20, 25, and 30 years. So what that means is that, when you first set up this policy, you have to determine how long you want this policy to last. What is the term of the insurance policy? How long do you want to have it, right? So, generally, term life insurance policies generally don't exceed 30 years, right? So that means that if you are, let's say you're 20 today, and you get a 30-year term life policy, what can happen is, when you turn 50, that policy is going to expire. And so if you die after 50, there is no death benefit for your family. So now let's talk about the next thing. Coverage age amounts vary depending on the policy. Coverage amounts vary depending on the policy, but can go into the millions, right? So the first thing you do when you're setting up a policy is, first of all, determine how long you want the policy to be, if it's going to be a term life policy. The second part is you need to figure out how much insurance you want. Do you want $10,000 of insurance? Do you want $50,000 of insurance? Do you want $1 million worth of insurance? The more insurance coverage you have, the higher the monthly or quarterly or semi-annually or annually, if you're going to pay it annually one time a year, the higher that payment is going to be. So always bear that in mind, right? But one of the things you want to think about when you're thinking about insurance is, what is the average cost of a burial? I mean, that's probably one of the biggest expenses that your family is going to have to deal with in the event that you pass away. They need to worry about that. So, term life is a great insurance product, but it also depends on where you are in life and how old you are, right? Because you want to make sure the whole purpose of setting up a life insurance policy is to ensure that when you pass away, there is money that is going to be available for your family. That money that's available for your family, that insurance payout, is called a death benefit, right? So you want to make sure that the death benefit is available for your family when you pass away. So if you're 20 and you set up a 30-year term life policy based on actuary tables, the average African-American male and female now lives into their 60s. So, term life may not make sense for you at that point, right? So keep that in mind. Okay, so there are two types of life insurance policies. The first one is a level premium term life policy. And what a level premium term life policy is, so basically what it does is it locks in the same price for the length of the policy. So that means that the premium that you pay, the monthly or quarterly, semi-annually, annual payment that you pay for your life insurance is set at the same price. It's not going to change. Whatever it is, if it's $50 a month, it's going to be $50 a month for the life of the insurance policy. If it's $100 a month, it's going to be $100. There will be no volatility or fluctuation or change, right, in the insurance premium. Now, the second type of term life insurance policy is what's called an annual renewable term life policy. So this policy is a policy that it lasts for a year and automatically renews every year for the term that you've decided to set for that policy. Now, the thing about that is, because it is a renewable term life, an annual renewable term life policy, that means that at renewal, the premium that you pay is subject to change, right? So let's say that, you have a $100,000 death benefit on an annual renewable term life insurance policy. And let's say that in the first year, it's $50 a month. Every single month you pay into it, boom, right? Well, when it renews the next year, you may find that the new premium amount is $55 or $60, right? So it's not fixed for the entire term because there's an annual renewal on the insurance contract over the term of the term life insurance policy. So I wanted to talk about that as well. Now, so what are the pros of having term life? So oftentimes, a term life policy is generally the cheapest type of insurance policy that you can get in comparison to all the other insurance products. Generally, it's the cheapest, right? So I want to put that out there, right? So that is the pro to term life. It's generally the cheapest. Now, the downside to term life is that if you outlive the term of your term life insurance policy, so let's say, you got a 30-year policy, you're 20 years old, you live to 65, right? So your policy expired when you were 50. So if you outlive the term of that term life insurance policy, then what will happen is when you pass away, there will be no death benefit for the beneficiaries or the people that are supposed to receive the money when you pass away, because the term life policy has already reached its term and expired. So that's something to keep in mind as well, right? So let's move on to the next the next insurance product that I want to talk about, and that's called a whole life insurance product. And what is whole life insurance? So whole life insurance typically lasts until your death, as long as you pay the premiums, right? So the real difference between term life and whole life is that generally when you set up whole life, and I like whole life, I tend to use whole life type insurance products because I like insurance products that I know are going to be around for the entire time that I'm alive up until the time I die, provided that I make my premium payment on time every month like I'm supposed to, or every quarter like I'm supposed to, depending on which insurance policy I'm looking at. You know, some of my policies are monthly, some of them are quarterly, some of them are semi-annually actually. But in any event, the point is, right, that whole life policies typically last your entire life. So you don't have to worry about the term of your insurance policy expiring in a whole life insurance policy because there is no term. The term is the death benefit is valid and good and can be paid out provided you pay your premium payments on time now at the time that you die. So your beneficiaries will actually see a death benefit at the time that you die, provided you paid all your premiums. Now, in general, your premiums stay the same. You get a guaranteed rate of return on the policy's cash value, and the death benefit amount doesn't change. We're going to talk about cash value here shortly, right? And what cash value is and how cash value works. Just give me a second to get through these insurance policies, and then I'm going to come back and talk about cash value, right? Now, the pros to whole life is it covers you for your entire life and builds cash value, right? The con is it typically is more expensive than term life or other permanent policies, right? So, of course, a whole life insurance policy, because there is no term limit, there is no term expiration, obviously is going to cost more than a term life insurance policy. So I want that to be covered as well, right? Now, let's talk about universal life insurance. So this is the next insurance product that I want to talk about. It's called universal life insurance, right? So the first we're going to talk about is guaranteed universal life insurance. And I think guaranteed universal life insurance, honestly, is my favorite. It is my most favorite insurance product on the market. And when I break down all the reasons why, you'll understand. Okay, so now, how does it work? So first of all, the death benefit is guaranteed and your premiums won't change, right? So death benefit's guaranteed. Death benefit's going to be around till you die, provided you pay those premiums on time. There is typically little to no cash value within the policy, and insurers demand on-time payment. Insurers demand on-time payment. So what I like about guaranteed universal life insurance is that there is no cash value. And I'll tell you why I prefer insurance products with no cash value a little bit later in this video. But I like the fact that the death benefit is going to be available at the time that I die, provided that the premiums are paid on time. Now, here's the thing. The premium must be paid on time because of the type of insurance product it is. I mean, if you miss an insurance premium, if you're late on an insurance premium, there's a good probability that your insurance will lapse. Your insurance policy will lapse. And at that point in time, you will no longer have insurance in place, right? Now, the other thing that I like about guaranteed universal life insurance is you can choose the age which you want the death benefit guaranteed till, right? So for me, right, with my life insurance, with my guaranteed universal life insurance products, I just say I want it to be around till I'm 100, right? So I set the term, right? I set the term for how long I want my life insurance policy to be around. I always say 100. Actuary tables say that I'm not going to live to 100. It is very unlikely that I'm going to live to 100 based on, average death rates amongst African-American males. And so that being the case, I know that there is a greater than not likelihood that when I finally pass away, my death benefit will be available and inure to the benefit of the beneficiaries to be able to take care of any ancillary death burial insurance. So that burial and all of those casket, all of that great wonderful stuff, death burial fees and expenses, premiums, right? So that's that. That's what I like about that. Now, the pro of having a universal life insurance policy or a guaranteed universal life insurance policy is that due to the minimal cash value, it's cheaper than whole life and other forms of universal life insurance, right? So, I like that. It's more expensive than term life for sure, right? But it is cheaper than whole life, right? And so, because it doesn't have that cash benefit to it. And I'm not interested in the cash benefit. I don't want an insurance product with a cash benefit, which I'll get into a little bit later as to why. Now, the con of this is, like I told you, if you miss a payment, right, this is the downside. If you miss a payment, if you are not on time with your payments, there's a greater than not likelihood that you are going to lose your insurance policy. And that, what we call that is when the insurance policy lapses. We call that a lapse in the insurance policy. You didn't pay on time, you lost your coverage, period. That's what it means. Now, let's move on to some more interesting type of insurance products, right? So the next product we're going to talk about is what's called the Indexed Universal Life Insurance Policy. Now, this type of insurance policy links the policy's cash value component to a stock market index, like the S&P 500. Your gains are determined by a formula which is outlined in the policy. I know the formula that is pretty standard across the insurance industry, and I could get into that formula, but it's kind of complex, and I don't want to lose anybody in this discussion, so I won't go through the formula. But what I will say is this. When you calculate the formula and you look at the way cash value works on this type of product, I really don't think cash value is worth it, especially when we start talking about some of the other things that we're going to talk about as we progress in this video. And for those of you who don't know what cash value is, so sometimes there are some insurance products out there that give you a death benefit and a cash benefit. And what that cash benefit does is it allows you, like, it's basically like a kind of like an investment account. And so a portion of your money is invested in the stock market or, the securities market, because I mean, there's stocks, bonds, they invest in a number of different things depending on what type of product it is. And they generate a return on that money that's also to your benefit. And I know that sounds good right now, but hold on a second. I'm going to get to it in a second, right? So what are the good things about the Index Universal Life Insurance policy? What are the pros? So the pros are you can access the cash value, which grows over time and may see considerable gains if the stock market performs well. Within limits, your payment and death benefit amount are flexible. We're going to get into that more in a second. Now, the downside to this is that due to investment caps, the cash value doesn't take full advantage of stock market gains. Additionally, these policies are often more work than a term or whole life product as the investment requires monitoring, right? So they're going to give you they're going to invest in different funds and things of that nature, but you got to monitor those returns, right? Just like a typical investment account, you've got to monitor the gains and losses. You've got to monitor what's going on in the economy, et cetera, to be able to adjust the portfolio investment or the cash value portion of your insurance product to make sure that you're getting the maximum amount of return that you can possibly get on the cash value of your investment product. But let's talk about some other things. And now we're going to get into the reason why I don't like cash value based insurance products. I don't like cash benefit based or any type of insurance product that has any type of cash value or cash benefit to it. Let's talk about why. So the first thing I want to talk about is the participation rate, right? So what is a participation rate? The policy will dictate how much of your cash participates in any gains. If your participation rate, so for example, right, I'm gonna give you a good example. If your participation rate is 80% and the S&P 500 goes up 10%, you only get 8%. Think about that a second. Just stop and think about that a second. Simply by having a cash value benefit to your insurance product, if the S&P 500 goes up 10% and you have an 80% participation rate, you're only going to see 8% of that. It would have been a lot better to just invest your own money in an index fund directly to a standard brokerage account, right? Because you would have got the full 10%. But we're going to talk about that some more in a second. Now, here's the other thing. If the index fund goes down, so let's say the index fund goes down, right? Or the index overall goes down, you won't lose cash value. You just get zero rate of return, right? So I guess you could say one of the good things is that, if you're invested in a standardized brokerage account, right, you absorb the gains and the losses, whereby in an insurance product with a cash benefit, you see the gains at a participation rate and a cap rate, which I'm going to talk about cap rate next. You see the gains, but if the stock market goes down, you don't lose any of your cash value. So I guess for some people that sounds really, really good, but I'm going to break down to you how this really works and what the tricks are so you understand why I don't advocate cash value policies. Now, some policies offer a small guaranteed interest rate in case the market goes down. That's true. But don't think that's free, right? So policies that offer that small guaranteed interest rate also have higher premiums, right? So those higher premiums, when you do the math, actually outweighs the small guaranteed return you'd get if the market goes down. But we're going to talk about that more in a second. Okay. One of the other things that you have a problem with cash value type insurance product is what's called a cap on gains. What's a cap on gains? Your cash value gains are subject to a cap. So if the index goes up 20% and your cap is 10%, you only get a 10% rate of return. So where does the other 10% go? It goes to the insurance company's pockets, right? So basically, they are co-investing with you and they're capping your return. So they're investing your money. So, but they're a co-investor in the return, right? So what they're saying is, hey man, the stock market do 20%. We got you capped at 10. So we're going to happily collect our 10 and we're going to happily collect 10 of that. We're going to give you 10 of that. Hey man, that doesn't make sense to me. There is no realm of possibility where that type of investment, that type of arrangement makes sense to me, right? That may make sense to some other people. To me, it makes no sense, which is, again, another reason why I don't do cash value insurance-based products. Now, death benefit and flexible premiums. Now, the interesting thing about it is with these types of products, right? So with these types of products like the Index Universal Life Insurance product, right? What they have is a death benefit and flexible premium, right? So you're flexible on your death benefit and premium. And what that means is that you could actually increase or lower your death benefit based on your family's needs at the time that you decide to increase or decrease the death benefit. The other thing that you can do with these type of policies is you can skip a premium payment. So let's say you're on a monthly premium payment plan and you decide, let's say that premium was $100, right? You can skip that premium payment. Let's say you make it 1 month and then the next month you decide to skip that premium payment. You can do that. However, understand that when you skip that premium payment, they're still going to get their money. What they do is they take it from the cash value of your insurance product. So let's say your insurance product's cash value is at $500. They're going to take $100 out of that $500. So now your cash value is $400. So you still made the payment. You just made it through the cash value benefit of your insurance product. And if you don't have any cash value at the time that you skip the payment, your insurance policy will lapse. So that's the other thing that you need to understand about this, right? Now, so I want to share that with you as well. Are you seeing the foolery yet? Because there's a lot of foolery to this, right? But so there's a lot of things to know, right? So let's go ahead and keep moving forward. So the last two insurance products that I want to talk about are variable life insurance policies and variable universal life insurance policies, right? What are known as VULs. Now, what are they? So first of all, the cash value is tied to investments accounts, i.e. stocks, bonds, and mutual funds, right? Now, with the variable life insurance product, premiums are typically fixed and the death benefit is guaranteed, right? However, with variable universal life insurance policies or variable universal life insurance products or VULs, right? The premiums are adjustable and the death benefit is not guaranteed. So you need to know that. So let's talk about why I don't like cash-based products, right? Because these are the insurance products that I wanted to cover today. And the thing about it is I wanted to cover personal, like individual, like consumer insurance products. There will be a later time where I cover business insurance and key man insurance and different things of that nature when I start getting into the business section of the business side of our financial literacy, our hashtag for the Free Friday discussions. But today I just really wanted to cover the individual insurance products that are available to you. And I'm trying to take a very objective approach to that. However, right, now that we've covered all of those policies, I'm going to tell you why I don't like cash value products. Okay, so number one, right, and this is why insurance companies do it. You have to understand that the average rate of return on an index fund over a 10-year period of time, it averages 10 to 12% rates of return. What does that mean? What that means is that some years you'll make more, some years you'll make less, but on average, over a 10-year period of time, index funds and well-managed fund vehicles tend to, such as mutual funds, index funds, exchange-traded funds, et cetera, return a 10 to 12% per annum rate of return. Now, let's think about that. So if I'm capped at 10% in a cash value insurance product and the market brings back 20%, I only got 10. Yeah, sure. And if my participation rate is only 80% and the market yields 10%, then I only got 8%. Yeah, sure. There's some downside protection and the potential, if I'm willing to pay a higher premium, for a small guaranteed interest rate in the years where the stock market or the overall market or the index like the S&P 500, Dow Jones Industrial Average, et cetera, are not performing well. However, I'm actually losing in a cash benefit based insurance product. Why? Because while I may not suffer in a down market as far as my rate of return goes, the truth of the situation is because of the participation rate and the cap, I'm not making near as much money as I should be based on the averages. And because of that, long term, I'm actually losing money, which is why it is completely, in my opinion, utterly pointless to have a cash value based insurance product. Insurance products from the outset were never designed to be this way. Insurance products are really straightforward vehicles. They're designed to provide a death benefit to the beneficiaries that you've assigned in the event that you pass away. That's it. That's all. We don't need to complicate it any more than that, right? What we need to make sure in an insurance product is very simple. We need to make sure that the death benefit is going to be around as long as I'm alive. So when I die, my beneficiaries can get it. I want to make sure that my premiums are fixed, right? And for everything else, I can invest in a stock brokerage account. And myself, I can set up a standardized investment account, stock brokerage account, and I can just invest in index funds or ETF or mutual funds. And don't worry, we're going to talk about all of that very shortly. And very shortly coming up, we're going to be talking about the different types of investment vehicles, asset classes, things like that. But the net effect of it is because of the way it's structured, right? You actually lose long-term in a cash value-based insurance product, which is why cash-based insurance products, cash value-based insurance products, they really don't make a whole heck of a lot of sense when you can just simply take the money that would have been in the cash value portion of your insurance product and just simply set up a standard insurance product with a death benefit, take the difference and invest it into your own index funds, to your index funds that you choose through your standardized brokerage account. Just do that. By doing that, you're going to see more money. See, what you have to understand, and what I want you to take away from this discussion is I will need you to know, first of all, what the goal of investing is. And I don't know if I've covered that yet, but I think I need to cover it now, right? So the goal of investing, what we say on Wall Street is the goal of investing is to maximize capital appreciation while mitigating risk to its lowest common denominator. And what does that mean? It means that I want to make as much money as I can while taking the least amount of risk possible, right? So if I know that in a cash value based insurance product, they're going to be investing in the same types of index funds that I can access myself through a standardized brokerage account, then the highest rate of return that I can get based on two of the same types of investments in index fund. Let's say they're investing in a Vanguard or a Spider ETF, for example. Let's just say that that's the case. I can access that same Spider ETF in a standardized brokerage account. Apples to apples, I'm going to make more money in my standardized brokerage account long-term than I would in that cash valued insurance product. So therefore, the highest rate of return for my dollars at that point are in my standardized brokerage account, not in my cash valued insurance product. And so that being the case, I don't need to look at a cash valued insurance product because I have the knowledge, ability, and experience, and now so do you, to be able to vet that out, and target my money to a better performing situation with the same risk policy, with the same risk in place, right? So a Spider 500 ETF or an S&P 500 based index fund, the risk is the same if it's in the cash valued product or if it's in the standardized brokerage account. It's the same index fund. So if I'm going to Vanguard for that index fund and it's, let's say, a Vanguard S&P 500 index fund, and they're investing in the same Vanguard S&P 500 index fund, then the truth of the situation is the risk profile is exactly the same, but I'm going to get more money in a standardized brokerage account than I would get in my cash value based insurance product. So I hope I broke that down really well, and I hope you understand that. Because that is the reason, and that is the big reason why I don't do cash valued insurance based products. Like, it just makes no sense. There's a better, higher, and best use for my money where I'm going to get a better rate of return long term. So I'll just stick with that and use life insurance for what it's specifically designed to do, which is, again, provide a death benefit for my beneficiaries in the event that I die. That's it. Now, let's talk about these insurance agents, right? One of the things I need you to be aware of, and one of the things I need you to be very careful of, is this. If you've made it this far in the video, then this is probably the most important part of the video, or at least another important part in this video, which is this. By far and by wide, insurance brokers, people that come out to sell you insurance, or people that you talk to about insurance that you seek out yourself, by far and by wide are paid on commission, right? And based on the type of insurance product they sell you, their commission is higher, right? So a lot of unscrupulous insurance agents will try to put you in a cash value based insurance product because they get paid a higher commission for it, even though it's not the best product for your circumstances and situations, right? And this is why I strongly recommend that you don't buy insurance companies from multi-level marketing or direct marketing based companies like Primerica, World Financial Group, et cetera, et cetera, et cetera. I do not recommend that you work with them. I do not recommend that you buy insurance from them. And here's why, right? So interestingly enough, way early in my career, this was probably 2006, right? This is when I first started in my career. I was a junior loan officer. I had probably been in the mortgage industry I was a junior mortgage banker, but had probably been in the industry a grand total of 30 days. My old band teacher in high school, this one time at band camp. Anyway, listen, my old band teacher in high school, she was a part of World Financial Group, right? I forgot what they call themselves, what the reps call themselves, but she was part of World Financial Group. And she convinced me to come to one of their meetings. And at this time, mind you, I've been in the industry all of a month. So I know nothing, right? But she was like, you can make a whole lot of money. You know, you're going to be in business for yourself, but not by yourself. You know, you have support and a team, and there's a lot of money to be made, blah, 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 blah. She was on a recruiting pitch, right? I'm young, fresh out the military. I'm excited. I want to make some more money. I show up to the event, right? I get to the little meeting that they're having. It's music playing, a lot of people in the room, everybody clapping, everybody cheering, all of this, that, and the third, right? So I dealt with World Financial Group as one of their little reps or whatever for about 60 days, right? Here's what I learned in that 60-day period of time. They were training us, right, to sell nothing but variable universal life insurance products based on the fact that we would get the highest commission rate. The other thing they were training us to do, and this brings me to the next part of what I want to talk to you about with these insurance agents, is to front load the product, right? What does that mean to front load an insurance product, right? So an insurance company can collect their fees, right? Their fees, their expenses, their charges, their commissions, their interest, all of that stuff, they can collect it. They can collect it a couple of different ways. Number one, they can amortize the cost over the life of the insurance policy and collect it a little bit by little bit by little bit by little bit every time you make a premium payment until those fees and commissions, because that commission that the insurance agent gets paid, by the way, they recoup that. The insurance company recoups that from your premiums, right? So they can go ahead and do that over time, or what they can do is front load the product. By front loading the product, the insurance company begins to collect all of their fees right away. So what you find is most of your premium payments, this is another reason why cash value-based products are trash, because the portion of your premium payment that's supposed to go to your cash value, it won't go there for a long time, because what the insurance company is doing is taking the commission, the fees, the expenses, all of the ancillary costs for your policy out of your premiums up front, out of every single premium. So you are not even seeing any cash value until that's paid. But for the insurance agent, right, it does two things. Number one, if they front load the product, they get even a higher commission. Number two, right, the second thing about that is this: they have less of a probability of getting a chargeback, right? So insurance agents' commission is based on the total annual amount of your premium payments. They get a percentage of that. So what you do is you take your premium payment, you multiply it by 12, and then whatever their commission split is, they get that payment, they get that check, right, from the insurance company they work for, right? Now, if you fail to pay premium payments and that policy lapses within the first year, then they're subject to what's called a chargeback. The insurance agent's commission gets charged back. And what that means is, let's say you held the policy 6 months before the policy expired and they didn't front load the fees. What happens then is the next 6 months of that policy, that insurance agent's commission was based on that. So whatever that next 6 months of commission works out to be, they take that back from the insurance agent, right? So insurance agents, by far and by wide, a lot of them love to front load the product and put you in the highest paying commission-based product so they can maximize their income, right? And you need to be aware of this, and this is why we're having this discussion, so that way you know about the different types of insurance products, right? Number one. Number two, you understand how what it takes for a person to even be able to sell you insurance. And number three, so you can understand how insurance agents are thinking, right? So that's why it's very important that you do your due diligence on the insurance agent to make sure that other customers are satisfied with the service and the level of care that insurance agent provided to that to other customers, right? So due diligence is extremely, extremely, extremely important when it comes to dealing with insurance. So I just want to share those things with y'all today. So listen, that's all I got for y'all today, right? That's all I got for you. So I'm gonna go ahead and that's the end of this. So I hope that y'all liked this video. I hope y'all like this content. I hope y'all learned a lot. Hey, y'all, man, go ahead and hit that like button, hit that subscribe button, hit the bell notification, leave me a comment at the bottom of this video to let me know what you think. Definitely, most definitely hit that join button. So you can, if you're on an Android, definitely hit that join button. And if you're on an iPhone, definitely hit the link in the description or the link in the comments so you can join the hashtag Real Woke Live chat community and be eligible to participate in the hashtag Learn to Earn Cash giveaway, where I am giving away a minimum of $1,000 every single month right here on the hashtag Get Real Woke podcast. And in case you forgot, I'm giving away another $1,000 tomorrow live at 7 p.m. Eastern Standard Time during my live podcast episode tomorrow right here on the hashtag Get Real Woke podcast. So make sure between now and then you join the hashtag Real Woke Live chat community so you have an opportunity to participate and possibly win that money, baby. Let's get it. Also, the last thing I want to tell you, hey, listen, if you're interested in delving more into these concepts, going deeper into these concepts, I actually wrote a book called Investing for Success, Investing Tips for the Everyday Person. So I'm going to go ahead and drop that in the description if you're interested in picking that up, reading that, and delving deeper into the concepts that I cover on hashtag for the Free Fridays. All right, y'all? So with all of that said, I'll see y'all tomorrow on Situation Saturdays where I'll be giving away that $1,000, baby. So until tomorrow, I holla.